Hello, everyone, and welcome to the Honolulu, Hawaii Monthly Housing Report. I'm Patrick ONeill, Principal Broker at Luxury Homes International. And with me today is the president of TZ Economics and one of Hawaii's leading economists, Mr. Paul Brewbaker. How are you today, Paul?
Aloha, Patrick.
Aloha. And I might add Hawaii's favorite economist, just to make sure that we're clear there.
Out of all five.
Out of all five, that's right. So, Paul, it's incredible how much has happened in the last 30 days since we last spoke. And things have really moved quickly. So I'm going to pull something up
Yeah,
here, and I want to get your reaction to
sure.
Chairman Powell's statements.
Hmm.
And I'm sure you're aware of this. For the long term, what we need is supply and demand to get better aligned so that housing prices go up at a reasonable level, people can afford again. We in the housing market probably have to go through a correction to get back to that place. What do you make of those comments? That sounds pretty strong.
Yeah, this is actually a really important and maybe over nuanced reference to the literature in housing economics, which points to restrictions in housing supply, primarily regulatory restrictions to housing supply, as the primary cause of housing inaffordability in America, emerging over the last several decades. And so on the surface, it looks like, oh, he's talking about interest rates are too high, and well, probably the housing market and asset markets in general will have to go through correction. And that's true. It's a double entendre, or a double entendre, whatever, right? It has a double meaning, because if you read the beginning of the quotation, for the longer term, like in the long term, right now, interest rates are doing a slam dance on asset markets and interest sensitive asset prices and markets like housing and investment more than other parts of the economy. So that's now. But for the longer term, what we need is supply and demand to get better aligned. That is, when there's an increase in demand, supply has to be able to respond. And what we've done in America through the politics of NIMBY and heartfelt and important environmental and other concerns that have gone so far that they've limited the ability of housing supply to respond is that we've made supply inelastic. Demand moves around with interest rates, but supply is brittle. It doesn't stretch to match demand. And so we've got to, what he's saying there is, yeah, right now, interest rates, sure, short-term interest rates, yeah, I get that. But long-term, bringing interest rates back down which is going to happen, is not going to solve the problem. For that, we need supply and demand to be better aligned.
Right. And that's a much more complicated equation. Well,
And way outside the kuleana of the Federal Reserve
right.
Board.
Right. Well, you mentioned interest rates. Let's take a look at that next,
Yeah,
because that, of
yeah,
course, is the big story right now. This is
yeah.
from Freddie Mac.
That's the drone swarm that's attacking civilians right now. And
That's
I
right.
mean,
So last
maybe
week,
it's too soon for a
yeah,
humorous analogy.
30-year interest rate fixed went above 7%. As of today, perhaps it slid back a little bit.
Call it 7.
Okay,
Yeah.
let's just call it 7%. Where do you see this heading? Are we going to go up higher? Are we going to start seeing going lower? Do you have any thoughts on this?
Yeah, well, my own view is that it's already an overshoot. But of course, everything depends on where this all goes. And I think a lot will be revealed within about 6 months. For example, 6 months from now, we'll have passed the 1-year anniversary of the Russian invasion of Ukraine. So what did the Russian invasion of Ukraine do to oil prices? And what did the Russian invasion of Ukraine do to grain prices? Well, in both cases, those prices are higher than they would have been. You could just go look at the data, higher than they would have been had the invasion not occurred, had oil supplies not been cut off or embargoed, and had the grain harvest in the breadbasket of Central Europe not been undermined, and had not Russian merchant traders been essentially stealing Ukrainian grain and selling it on the black market. Well, if prices went up in February 2022, by the time you get to February 2023, if they're the same prices, February 2022 and February 2023, what's the inflation rate? 0, right? If it's the same price, then the inflation rate between the 2 dates is 0. So even if nothing is resolved in Ukraine, which could happen, there won't be any more inflation coming from that particular geopolitical event.
So everything is tied to inflation, and we're going to talk in detail your projections on that towards the end. Looking at the mortgage interest rates right now, is there any indication, do you think we're going to see further increases in the months ahead?
It's possible. Again, we have a bit of an overshoot in the sense that if you look at yields on longer term securities, in fact, we should look at yields on longer term securities, because every time they're moving so fast, and this is part of the problem, there's so much uncertainty that from day to day, you literally need to like check, which I'm going to do on my phone right now. So I go to markets on Bloomberg, and I go to bonds, and the 10-year yield is 4%, 4.01. So a 4% bond yield, long bond yield, or in this case, a 10-year yield, customarily is associated with a mortgage interest rate that's about 2 percentage points higher, actually 175 basis points higher. So 4% on the 10-year yield should give us 6% as a mortgage rate, and we're at 7%. So there's a risk premium. Maybe some of it's an inflation risk premium, but there's generalized uncertainty that's leading people to exit that market as people are exiting from the housing market and from the stock market, causing mortgage-backed securities prices to be lower and therefore mortgage interest rates to be higher. And one of the players that's exiting, by the way, is the Federal Reserve itself, who were buying $65 billion each month in mortgage-backed securities. And as of last month, as of September, following through on their pre-announced shift towards what's called quantitative tightening, the Federal Reserve no longer is replacing $65 billion in mortgage-backed securities that roll off of the Fed's balance sheet each month. So
which potentially will be pushing interest rates higher.
That's right, because they're not supporting prices at the same moment that people are fleeing from some of these asset markets.
All right. Well, we'll come back to this when we double back around for the inflation, because that's really what this is all tied to. So let's jump into some of the real estate statistics. This is from the Honolulu Board of Realtors, the figures that were just released. And I think, one of the big stories here, obviously, would be the closed sales numbers. And we've got single family on the left, condo on the right. Single family down 34%, condos down 20%. That's a substantial drop. This is compared to last year. And we looked across all the islands. Maui down 50%. This is the number of single family home sales. Kauai down 58%. This is across the state. This is a big deal, right? These kind of numbers.
Yeah. And it's important to think a little about why each of these counties differ, but yeah, that's definitely. So the story, if you remember, since the pandemic began, has been partly an interest rate story, but not uniquely an interest rate story. Part of the story has been the impact of changing workplace preferences on the pattern of housing demand, housing preferences. And in the case of islands like Maui and Kauai, an unusually distinctive participation post-COVID of investors who have been liberated from conventional workplaces and can work remotely because of occupations or industries in which they participate that enable them to use connectivity as a substitute for commuting to an actual workplace and in-person collaboration with virtual alternatives. And so that's a one-time shift. We think maybe about 10 or 20% of the workforce has made a shift to full-time or hybrid remote arrangements, and from 10% pre-COVID, maybe 20% post-COVID. And as you know, there's only a small proportion of houses that are transacting in the market in any given year, maybe 3% of the total. I can't remember. It's not 5, I don't think. And so most people don't move every year, right? Most people just stay where they were living before. And so when you have that many people change their work circumstances, and potentially permanently, because this technology is so compelling. I mean, we know, for example, that most, if not all, of the productivity growth in the US in the last 2 years came from remote work. Didn't actually come from traditional work environments.
Oh,
And
interesting.
it's so profound an impact that we also have literature now from the Federal Reserve Bank of San Francisco documenting that. In fact, a regular website you can go to and find the, I think it's daily updates, maybe
Well,
weekly,
so now,
showing that.
but we're seeing this pullback. So is part
Yeah,
of that people returning to the office, or this is just simply
no,
the real estate
part
market?
of it, so part of it is higher interest rates and that whole thing, the Federal Reserve and so on. The fact that we've had in the last year more inflation that was expected, and a result of the unexpected inflation, the Federal Reserve having to raise interest rates faster and more than what previously might have been expected, given that we understand that their anti-inflation posture is credible. But in addition, we have this other part, which is this remote work part. And that was always a one-time shift, right? So while the shift is occurring, you get this impact on the housing market. Once everybody sorted themselves out, I think we're at that point,
Yes.
that force goes away. And so, yeah, it's a one-time thing, but as it goes away, all those sales that were happening in the summer of 2021, let's say, that
Yes.
were being driven by people realizing that they
Yes.
didn't have to, they could go live in suburbs and exurbs and Zoom towns across America. That
Got it.
one-time effect is now gone.
Okay. Yeah. Well, let's take a look. This is closed sales. This is the island of Oahu. And we're going back to late 2019. I've talked about this quite a bit. The
Yeah,
market was starting to correct at that point.
right.
And now we are where we are after going through the COVID spike, if you will. Closed
Right.
sales here. Does this suggest anything to you when you look at this chart?
Well,
Looks like,
again, it's tempting to go ahead. You were about to say
I was
something.
going to say, it looks like single family homes are right where we were in the correction of 2019.
Yeah,
Condos seem to be above.
yeah, yeah, lower. Although I would invert the last part of what you said, that you think about why condos um, from September 2019 through, let's say, what do we have? Let's just say September 2020. Think about why condos would have collapsed by so much more, condo sales volumes by so much more than single family home sales. What was going on in 2019? Oh, the city and county of Honolulu was cracking down on vacation rentals. And then came 6 months of no tourism, right? So first you have the police are coming to raid your vacation rental, the vacation rental police. And then second, nobody was flying to Hawaii until pre-flight PCR testing protocols were invoked in October 15th, 2021. So between the summer of 2019, when the city adopted this heightened enforcement regime of their prior ban on undocumented vacation rentals seeking a pathway to citizenship, and October 15th, when we finally got a travel protocol that allowed people to come to Hawaii without a 14-day quarantine, we had this huge pressure on the vacation rental market, a big proportion of which was condos, both in resort areas like Waikiki and then outside.
Yeah. And certainly during COVID, like we talked, the preference was get into the single family
and
home,
then the
stay out of
beginning of this
condos, right?
preference shift, absolutely.
Sure.
We saw that in 2020 in spades, yeah.
Well, what does the future hold? There's only one way to look at that is the pending sales figures, which we're going to look at when we come back from a really short break. So stand by. We'll be right back
Sounds
with
good.
economist Paul Brewbaker. And welcome back with economist Paul Brewbaker. I'm Patrick ONeill with Luxury Homes International. And Paul, we're just about to look into the future. Your amazing Kreskin envelope, you put that on. So we're going to take a look at pending sales. And again, this is from the Honolulu Board of Realtors, statistics just released from last month. And this is, I mean, almost kind of shocking to me when I look at this, the pending sales numbers, down nearly 44% for single family homes, down 30% for condos. I mean, this kind of tells us what's ahead, right? This is what we're going to start to see show up next month, something along these lines. And I'll point out, this is the 6th consecutive month of decline on the pending sales numbers. Not really a big surprise to anybody that's watching. The next number is the active inventory, right? And this is another shocker to me. Single family homes inventory up 44%. The same as pending is down 44. Supply and demand, right? You'd think we're going to start to see some softening in that area.
Well, think about what you're saying too, is the bathtub is filling up, right? The pending inventory is filling up, even though the water coming into the bathtub has been turned off, right? Did I get that right? Yeah.
No, the water's still coming in, right? Right. So inventory building up, but the sales are going down.
Okay, gotcha.
Yeah, bathtub is draining slower.
Well, not the listings. Okay, we skipped over listings, but the listings have fallen. So the absorption, right? The drain is not enough. The bathtub to death, but
that's right. So but inventory at 44%, certainly good news for homeowner or home buyers out there looking for homes. Condos up 10%. I mean, still something substantial. And if we take a look at active inventory, one thing I want to point out, we're still 40% below where we were pre-COVID. What do you think about this, and what do you see?
Remember that pre-COVID, the Federal Reserve had already begun to normalize interest rates in 2017 and 2008. Now, the markets were a little unhappy about that, and Powell had to step in. The Fed had to step in and reverse course a little bit in the year before COVID, but there had already been early strides towards interest rate normalization or higher interest rates in the late 20 teens that and then some idiosyncratic Hawaii-related, issues. Nobody will talk about them, but Hawaii probably was in a recession at least once in the 2018-2019 period, if not twice, depends on how you're, measuring it. But GDP declined and unemployment went up, and jobs went down, and nobody was talking about it. It was like, oh, it's all great. So everybody was talking about another record year for tourism, which was totally wrong. And so there were macroeconomic fundamentals in Hawaii that detached from the national, right? The national economy is growing, and Hawaii took an off ramp after 2017, during which time the Fed was raising interest rates or normalizing, getting them back to normal, which meant mortgage rates were higher a little bit, and began to, soften the absorption in the housing market. In fact, you can see it in home prices. Well, we can look at it in a second if you want.
Yeah. Okay. Well, let's take a look then. Median sales price. Again, from the Honolulu Board of Realtors, flat compared to last month, down 2.3, up 0.8. If we look compared to last year, now it's single digits, and we were always talking at least double digits, and we're talking 20s for the single family homes in the past couple of years. Year to date, up 13%. I think that might continue to drop as we move forward for single family, 9% for condos, but still compared to 2 years ago, single family homes are 36% higher, condos 18% higher.
Yeah, but you really have to look at, right, the peak was 6 months ago. So if you look, it's higher than 12 months ago, but not higher than 6 months ago. And that is to say we've reached, there was a turning point in valuations, and of course there's been a big turning point in sales, and maybe we can look at that on a seasonally adjusted basis with some of the slides I have. So you were talking about interest rates, and that's obviously the big short-term factor right now. But as I suggested, and this has been going on for a year now, but as I suggested, half of what we were seeing, for example, these Federal Reserve data out of San Francisco, half of the price appreciation nationwide in the last 2 years is attributable to remote work. And the other half is from low interest rates and this sort of the energy that housing had during the part of the pandemic where people were sorting things out, while getting vaccinated and whatnot. Now, those higher mortgage interest rates are being driven by not just the reality of higher interest rates in general. We talked about the 10-year yield a second ago, which is now at this graphic is about a month old. So the 10-year yield right now is here at 4%. Well, that's exactly where the Fed was telling us that they think they're going to have to go with the overnight rate by the end of this year. And then this is what they told us about next year and the out years. Now, they've been behind the curve, but at some point, I think they'll have caught up, and that may be now. So when you ask me what I think, where do I think things are going? I don't think things need to vary much from this, but there's so much uncertainty associated with it. And even at the Fed, you see that the blue bandwidth here, that's the difference in opinion between the highest and the lowest of the projections that are being submitted to the Federal Open Market Committee by its 19 members, right? There's 19.
So theoretically, and this is, a lot of ifs, because you said there's so much
a lot of
unknown,
uncertainty.
but theoretically, if this perfect world played out, which the Fed was hoping for, that would mean maybe the 30-year rates kind of follow this a little bit, and we see maybe a little upward tick into next year, but then start to see the retracement on the interest rates.
Ideally, the 30-year mortgage rate already has overshot at 7% and should begin working its way back down to 6%. The problem is there's so much uncertainty. I don't know what Vladimir Putin's going to do. Is he going to go tactical nuclear? I mean, who knows, right? And that uncertainty admits the possibility of, an 8% mortgage rate or higher, as opposed to a 6% mortgage rate where it should be now, or lower. So it's, that's why everybody's kind of pulling back, and people aren't listing their houses because they don't know what's going to happen.
Right.
And when you,
oh, sorry, Paul, I just on the end, the interest rate. So, and I know you and I've talked about this before. In a normalized world, whatever that means anymore, is the 5 to 6% interest rate kind of where a normal world should be?
Yeah, in fact, we look for some guidance about normalization back here where it says normalization. The Fed, you see the Fed normalizing, and what that means is short-term rates are coming up, but long-term rates are staying the same around 3%. Well, in a normal, relatively risk and uncertainty-free environment, the spread should be, let's say, 175 basis points. So a 3% 10-year yield instead of 4, which is what we have now, should be consistent with a 5.5 or 6%. Did I get that right? 4.5 or 6 or 5% mortgage rate. Call it 5. 5's good money for mortgage interest.
Yes.
7's a little bit of a push, and 3 was dirt cheap. I hope you did a deal.
Yeah. And if you don't worry, it's going up.
Wait
to
5
7.
minutes, take a chill pill, go binge something on Netflix for 6 months, and come back in the spring and call your favorite realtor up, and come out of your groundhog hole in the spring and say, have a look around. Did the Ukrainians kick Putin's ass? Yeah. Okay. Good. I should look at a couple other of the data sets you've already shown for a couple of reasons. One of which is that I seasonally adjust the data, so you can really see the inverted U-shaped profile of these sales volumes adjusting for seasonality, right? Sales always always decline in the fall relative to summer. I think that's why it's called the fall. No, maybe not. But once you take that into effect, you can clearly see a really hard stop, a sudden stop, if you will. Although on the single family side, you can see things fading already in the summer of 2021. And in fact, I can think of 2 people who a year ago named Patrick and Paul, who were talking about this a year ago, that there's a little bit too much of bubbleiciousness, and that the remote work adjustment has a finite duration to it, et cetera, et cetera. In terms of months of inventory remaining, here is a seasonally adjusted illustration of what happens when there's no tourism and when there's a slam dance, enforcement slam dance on vacation rentals. You put those two things together, the city and county of Honolulu saying vacation rentals, GTFOOH, and 6 months of no travel until a pre-boarding PCR COVID testing protocol could be installed in October 2020, and just a huge buildup in the condo spaces. People are trying to, right? It's a fire sale, trying to get rid of that vacation rental that hasn't been making money for 6 months to a year, and that puts them at risk of an enforcement action by the city.
Paul, could we go back to your previous slide on the number of sales? So clearly this thing is trailed off. Where do you kind of see this heading?
Well, what I was emphasizing, two things. One is the sudden stop that's happened since mortgage rates and the Fed really began to tighten aggressively. But the other is this arc, this inverted U, began much earlier on the single family side, whereas condos stayed robust all through. And in fact, if you read the Honolulu Board of Realtors press releases, this is what press releases do. They emphasize, what's the best news? The best news is that condo sales are still high, even though single family home sales were already trailing off, which should have been an indication that something was afoot. And what was afoot was this one-time surge in single family home prices. As I say, the peak was 6 months ago. So yes, prices are higher now than they were a year ago, but they're lower than they were 6 months ago on a seasonally adjusted basis in the single family space, where that preference shift towards detached dwellings in the remote work transition was more robust than in the condo space, where the main thing that's happened in condo prices is that they've gotten back, median condo prices, is they've gotten back in alignment with the trend in the 20 teens, from which they were drifting below in the late 20 teens during this I called it the Voldemort recession. We don't talk about it in Hawaii. We do not say the name recession.
That's right. So now when we look at this, when we look at that, clearly, so condos have bounced around on the long-term trend line. We talked about this before, but they have been below. They've been, trending below.
They had been below. I mean, if you're going to get the English grammar book out.
Thank you.
They had been below, and they they realigned with the pre-existing, pre-COVID, pre-Voldemort recession.
Whereas single family clearly had this big spike, whatever you want to call it.
Yeah, bubblicious.
So the question has always been, is it a bubble? Is it not a bubble? But before we talk about that, because I know you have, we've talked extensively about bubble, no bubble, right? But what I want to do is I want to just take a really real short break, and we come back. I want to look at the last two bubblicious cycles, the Japanese bubble period and 2007. So, and by the way, if you're watching this on video and you're enjoying this, please give Paul a thumbs up down below. And if you don't want to miss next month's market report, you may want to also subscribe to this channel. So stand by. We'll be right back. We're going to take a look at the last two cycles and see how it compares to this one. And welcome back. We're with economist Paul Brewbaker. And Paul, we're just about to compare this cycle, if you will, to the last two clearly bubblicious or bubbles that we had. So let me pull my screen up one more time. And you and I have talked extensively about this in the past. But let's take a look at this. So this is the median sales price for single family homes. And I've sort of highlighted the Japanese bubble period, the 89-90, and then the subprime bubble. And, we don't have to go back and revisit entirely, but these were the moments when we broke above the 20s in price appreciation, which we almost did in 2021, right? We hit 19.3, but we didn't
Yeah.
quite do it.
Yeah.
Right now, we're trending 13.3 through September. I think that number is probably going to be a little bit lower by the time we end. Do you see any comparison price-wise to these other run-ups and therefore the corrections?
It might be negative actually by the time we get to December. Um, do I see what? Say that again.
Do you see any comparison? Because what happens at
Yeah.
the end of
Yeah.
these periods is we see a depreciation of prices, pretty
Yeah.
substantial.
Yeah. So this time, first of all, I usually call it the Japan bubble. I don't know why that makes a difference, but maybe we
Okay.
shouldn't call it the Japanese bubble.
You know what the problem is? I'm just not as woke as you are, but I
No,
will. I'm going to change that.
It's one of these weird things, right? I'm not a Californian. I'm not a Hawaiian, but I could be a Californian.
Okay.
Language matters. Second, I think you'll see that in each of those two bubble experiences that you highlight, that both go look at the condos column for a second, that both condos and single family homes experienced similar and similarly quantitatively large accelerations and then bursting of the bubbles and subsequent declines, both single family and condo. Whereas look at the 2021 and 2022 period, you don't see that on the condo side. You see 1.2%, 2.4%, 9.29. That's kind of interesting, high single digits, but it's not double digits and it's not 20%. And so, and we looked at that a second ago, the fact that there really seemed to be something concentrated on one side of the market, not the other. A bubble has to happen in both sides of the market, but moreover, a bubble can't have a fundamental reason for existing. And the divergence between single family and condo prices on Oahu did have one, which was the remote work adjustment.
So the difference would be, okay, of course, the two markets they did not go up with each other. But what if I rephrased it and I said, were we in a single family home housing bubble? You would say no, because there was a fundamental reason why that happened.
That's right. But then now the question is, as you tried to get me to answer, where do we go now? And is there more downside risk on the single family side, say, than on the condo side? And there could be. I mean, I can't rule that out right now. Condos, as we saw in the graphic we were looking at earlier before the break, condos are basically fairly valued if you thought that that escalator in the 20 teens, about a 5% rate of increase is the right rate of appreciation. Single family homes were on closer to a 4% path than a 5% path. And that's because condos came out of a deeper hole a decade ago. But either way, the question right now is, will single family homes collapse to that trend or simply go sideways and meet the trend like next year? And, you know, I honestly don't know. I don't think there's, it's not like the rug got pulled away. But yeah, 9% mortgage rate could do that.
Yeah,
maybe
I mean, anecdotally, for sure, we're seeing, if we look neighborhood by neighborhood, actually what's happening, we have sellers who are living in last year. My neighbor sold it for that. We have buyers looking a year from now thinking, hey, interest rates are going to be higher. The world's going to be worse shape. I'm not willing to pay that. And there's that little bit of a rub right now, which always happens when the market sort of shifts.
Not to get more complicated than it needs to be, but I like to think of people looking forward as having an option to see, holding an option to see what the future reveals. Like, is it worth waiting to see if interest rates are actually lower a year from now? And I think as high as they are right now, and as high as they are relative to what we think is normal, or whatever the new normal is, or what normalization looks like, that's not a bad, waiting right now is not a bad bet.
Yes. Okay. And then, so I think we were going to wrap up. You had
we were going to think a little about where did this all come from? And it came from the pandemic and the inflation that followed the pandemic. And the way that these are the Hawaii inflation numbers, and I've broken them out. They've changed the frequency, so I can't connect the dots. But you see the dark blobs, which is the dots, which are the core rate. So it's the rate of inflation excluding food and energy prices. And I'll make clear in a second why that's true or why that's necessary. And then the headline rate, the one that literally grabs the headlines, which are the pukas. And you can see right now that the core rate's about 4%, and the headline rate is about 6.5%. And the heavy horizontal line I've drawn in there is the 2% inflation goal of the Federal Reserve. Turns out for the CPI, that's more like 2.5%, but let's just call it 2%. And you can see how both of those rates, core and headline rates for the urban Hawaii measures, forget the mainland, this is Hawaii inflation. You can see how on average, it was about 2%, maybe even a little below 2% on average pre-COVID. Then comes COVID. There's kind of a moment where everybody's hiding out. And then between fiscal stimuli and getting bored, sheltering in place and ripping off your mask and going to a rave and getting vaccinated, and probably not in that order, you can see how the explosion in demand for primarily goods, not services, that were still jammed up in production by supply chain disarticulation, the fact that the global supply chain was disrupted by the pandemic and so on and so forth, meant that more demand without the supply response, just like in housing, caused prices and inflation to go up. Now, the difference between headline and core inflation are the energy and food costs that make up the bulk of what's problematic about inflation. The overall inflation rate, as I said, about 6.5%, let's say, has leading it upward these fuel costs and the food costs that we know are partly embedded in the Russian invasion of Ukraine, and partly more broadly a legacy of the disruption to supply globally at a time when demand was beginning to recover. A curious example of that is in the vehicle market, where new vehicles are seeing their supply chains restored, but used vehicles experiencing dramatic inflation, because when people can't buy a new car, they turn to the used car market, and that bids up those prices. Now, we think of those things as transitory. We don't think of those things as lasting. Like, you know, if we get to February 2022 and we're at the same $90 barrel oil price that we were after the invasion, the price went higher, but it came back to $90 a barrel. That's zero. $90 a year ago and $90 today per barrel is zero inflation. So we should see some of those things.
And you know, I
burn
think
off.
we've heard economists say since the beginning of inflation rates going up, it's transitory.
Yeah.
It's transitory.
Well,
it's transitory. It's like 2-3 years now. Yes, it's transitory eventually. You know, 6 years from now, when we all
but I
say,
think
yeah,
I don't have the data to demonstrate
yes,
this, but I think if you look at those two bubbles that we just looked at
yes,
in the early 2000s and the late 1980s, and in fact, another period of even longer extended inflation from the mid 1960s through the late 1970s, in each of those cases, we're talking about 5, 10, 15 years of extended inflation. Right now, we're talking about 18 months, so you can already see the turn. You see what I mean?
I
It
do.
literally started in
So,
March 2021, and as of September 2022, you can already see the headline, the pukas starting to, they're just not coming down fast enough. And the core remains, see how the core is stuck at 4? The Fed is trying to get the core down to 2.
right.
That's
Other
the
than
heavy
energy, it seems the majority of that is supply chain issue still, which eventually is going to be
It's about
corrected.
half. The supply chain, the Fed can't fix the supply chain. Only the producers and the distributors can.
Right.
But the Fed must work on the core part because it's not easing back on its own.
Yes.
And unfortunately, that sucks the housing market into that vortex.
Okay. Perfect. All right, Paul, let's wrap this up with a lightning round, because I love asking you these questions.
Okay.
Okay, so the question is, 1 year from now, higher, lower, about the same? Inflation 1 year from now.
Headline rate lower, core slightly lower. I would say core rate 3, headline rate 4.
Okay. Mortgage interest rates.
I'm sorry, you said 1 year from now? I'm
1
sorry,
year from now.
I did 6 months from now.
Sorry, okay.
I think core will have converged with headline at around 3%.
Wow.
Yeah.
Okay. Wow. Okay, you heard that here first. Okay, mortgage interest rates, higher, lower, about the same?
I'm gonna guess lower a little bit. I hope a lot, but
Okay.
yeah, I already think 7% is too high.
Okay. Single family home prices a year from now.
Oh, if we're lucky, about the same. There could be some compression. It depends. You know, there's another thing we didn't talk about, which is that people have been leaving Oahu for 6, 7 years. And I used to joke about that. You know, I used to joke that Honolulu is Detroit. But the other day, I actually looked at the data, and Honolulu in the 2020s is Detroit in the
Wow.
1970s.
For population loss.
So what happened in Detroit was population and manufacturing and so on and so forth was rising until 1970. And since then, Detroit's been doing this.
Ah, interesting. Okay. Okay.
I think that's where we're at. Yeah.
Wow. One last one, condo prices, higher, lower, about the same.
Higher.
Oh, interesting. So single family, perhaps the same, slightly lower. You think condo prices, perhaps a little higher.
Well,
A year from now.
I should, we need to be a little careful with that, because I think there's a lot of higher end condos that are going to have a little more difficulty with absorption. But condos in general, right,
Mhm.
remain the entry point, you know, for regular people,
Yeah.
not to
Yeah.
mention first time buyers. Yeah.
For sure. Well, Paul, always such a pleasure. Oh, by the way, we're checking with the judges, and it turns out, yes, all your answers were correct again. So you
I'm glad you don't keep track, because I know I don't.
pass the lightning round.
Actually,
Now, I'm going to pull all these up later on and then hold
well,
you
we
to
should do
your
an
word.
episode where we go back on YouTube and listen to ourselves from
That's
a year
right.
ago.
That's right. We'll do the at the annual event, we'll do that.
We'll do the
So
Mystery Science Theater 2000
that's good. That's good.
version.
Hey, Paul, really, it's always a pleasure. And if you're watching this video, truly, if you've enjoyed it, please give us a thumbs up down below. And Paul, look forward to seeing you next month. And we'll do this one more time. So that's it for today, everyone. Stay safe, be well, and aloha.
Aloha.